We're so glad that you came because we're in for a lively conversation for the next hour with Neel Kashkari. He's been 2 years at the Minneapolis Federal Reserve. He began his career as an aerospace engineer at a private company in California, where he worked on NASA space missions. He was in Goldman Sachs for a while in San Francisco, and most of you probably know his name as Assistant Secretary of the Treasury, where he oversaw the Troubled Asset Relief Program, TARP. Following his time in Washington, working in the Treasury, Dr. Kashkari returned to California, joined the investment management firm PIMCO as a managing director. He ran for governor of the state of California on the Republican ticket in 2014, and he's pretty well known nationally for having maybe a difference of opinion of some of the other Federal Reserve presidents on keeping interest rates down, this question of too big to fail that maybe we'll get into, and issues of economic and social disparities, something that I know is of interest to everybody here. So please join me in welcoming Federal Reserve President of Minneapolis, Neel Kashkari.
Thank you. Thank you, Scott. Well, Scott and all of you, thank you for inviting me. Thank you for being here today. I'm really looking forward to having an active conversation with all of you. I'm not here to give a speech. I'm here to learn and listen and have a conversation. I always like to start by just giving you a little bit of background about the Federal Reserve and why I'm here and why there is a Federal Reserve Bank of Minneapolis in the first place. Most people don't know this. If you go back, so the Federal Reserve is our nation's central bank. The mission of a central bank, more than anything, is to try to manage some of the ups and downs of the economy. And typically when an economy is booming, a central bank will raise interest rates to try to calm things down a little bit so it doesn't overheat. Or if the economy is falling, you'll often see a central bank cut interest rates to try to boost the economy by getting more lending going. So that's basically what a central bank does at a high level. But something is unique about our central bank, the Federal Reserve, which is our nation always hated the idea of having a central bank at all because it sounded very undemocratic. Alexander Hamilton created the first central bank, lasted for a decade or two. They got rid of it. Then there was another one. They got rid of it. They said, we don't like these bankers in a dark room doing God knows what. It just sounds very un-American. So let's not have a central bank. And then in the late 1800s, our economy was hammered with financial crises, including a really big one, the banking panic of 1907. And then Congress said, well, even though we hate the idea of having a central bank, I guess we need to have one. But if we're going to have one, we don't want it all concentrated in Washington, D.C. Let's spread it out around the country so we can have a distribution of power, so it's not under the thumb of any one party in Washington. And that's what they did. They created the Federal Reserve System, which is the Board of Governors in Washington, and then 12 regional Federal Reserve banks spread out around the country, including the Federal Reserve Bank of Minneapolis. So our job at the Minneapolis Fed is honestly to represent all of you, to represent what's called the 9th Federal Reserve District, which is Minnesota, North and South Dakota, Montana, Upper Peninsula of Michigan, and Northwestern Wisconsin. And when I go back to Washington, D.C. 8 times a year and we set interest rates for the country, my job is to be able to talk about what's happening in our regional economy and bring that regional perspective back to national policymaking. So the reason I'm telling you that is the reason that I'm here is to hear from you directly on what's happening here in Winona, what's happening in the local economy. Are students able to find jobs? What's happening to wages? All of this information is really important to me to make sense of what's happening in the economy and bring that back to Washington, D.C. So the more open and honest and direct you are with me, the more I'm going to learn from you. And that ultimately is why I'm here, to learn and to hear from you. And so I hope we will have an open and robust Q&A. And I always like to say this, and I mean it, fire away. Ask me your toughest question. Give me your toughest comment. That's going to make sure that I learn as much as I possibly can from you. So thanks for being here.
Well, and thank you for your transparency and your willingness to come to Winona, learn about what we're experiencing in Winona, and for engaging with us in some Q&A later. So maybe my first question is, could you talk a little bit about the Troubled Asset Relief Program, TARP?
Sure.
What were your goals going into that? How did you think about it? And Now that we're some years past, how does it look in hindsight? Did it achieve what you hoped it would achieve? Did it do what you thought it would do, or not?
Sure. So I went to the U.S. Treasury Department in July of 2006, a year before the financial crisis hit. And I have to tell you, we didn't see it coming. We were looking, we missed it. Didn't see the housing correction, didn't see the crisis coming. And I was appointed by President Bush, and then I stayed under President Obama for a time. We hated the idea of using taxpayer money to intervene in markets. I mean, we were the Bush administration. We said free markets should work. If you took a risk, you bear the consequences of that risk, whether you're an individual or you're a big bank, that's on you. But then as the crisis got worse and worse and worse, and we realized we might be facing a Great Depression type collapse, then we knew we had no choice. We had to go to Congress and ask for the authority to step in and bail out the financial system. We hated that we had to do it. It was absolutely necessary. It was the right thing to do. And I'm proud of our country. It was a bipartisan response. Republicans and Democrats came together and did something deeply unpopular. At the end of the day, it was successful. I mean, it stabilized the financial system. It prevented the Great Recession from becoming the Great Depression. And at the end of the day, we basically got virtually all the money back for taxpayers that we ended up putting in at the start. But the point of this was the U.S. economy had a massive heart attack. So we took the patient to the emergency room, we did a massive intervention on the heart, and we stabilized the patient. But then we were in for a long, hard recovery, as one has after you have a massive heart attack. And that was the long, slow recovery that the U.S. economy experienced. So I'm proud of the work that we did. I hope we never, ever, ever have to do it again. And that's why at the Minneapolis Fed, we've done a lot of work on the issue of too big to fail banks. In my judgment, the biggest banks in America are still too big to fail. They need a lot more capital to make sure that taxpayers are never on the hook again. And we should not declare victory too soon.
So we might come back to this question of
Sure.
too big to fail
Yeah.
versus community banking and stuff, but maybe as a follow-up question to that, what would be the conditions under which government should sort of intervene to bail out big banks, big corporations? What would be the circumstances that would warrant doing a thing?
Well, former Fed Chairman Ben Bernanke had an analogy of a house on fire. So we've all been taught, don't smoke in bed. Well, first of all, don't smoke. But then don't smoke in bed, because if you fall asleep and you're smoking in bed, you can start a fire and you can burn your house down and you can die. So let's imagine that your neighbor ignores that advice. Your neighbor smokes in bed. His house catches on fire. You know, one could ask, why should we send in the fire department? He's been warned. Why should we send in the fire department to put his house out, the fire out? Well, the reason is because all of our homes are built close together. And if his house burns down, it might burn down the whole neighborhood. And so even though he doesn't deserve it, you send in the fire department to put the fire out. That's the scenario we faced in 2008, where nobody said, let's go bail out the big banks for their own sake. I mean, screw them, right? They didn't deserve it. It was that their collapse was bringing down the rest of the economy for the rest of us. And those are the conditions when it made sense to use taxpayer money to go in and stabilize the banks. But again, we never ever want to have to do that again. And the way we do that, the way we protect ourselves, is to make sure the banks have enough buffer, enough margin for safety, so that if they make a mistake, they don't need to turn to taxpayers. They can take care of the problems themselves. And they didn't have that buffer going into the last crisis.
Thank you. We want to get some questions from the audience. So let me lay down one ground rule, which is if you have a question, we want to make sure everybody gets a chance to ask their question, and our time is limited. So if you've asked a question, I'm going to ask you not, please, to have a follow-up question until others have had a chance to ask their question. And then if things have settled down and there's a time to come back to you, we will do that. But otherwise, I would ask you just please ask one question, and then we'll see who else has questions here. And we'd love to hear from students, and we'd love to hear from the community members that are here, and we'd love to hear from faculty. So who has a question? And if you want to do your question in the form of a Hamilton-style rap, that would be especially welcome.
And we have a microphone.
We'll see if that, yeah, we get a microphone so you can put down the beat. Jerry Pappenfuss, I think, gets the first question.
I'm going to go right here.
Hold on for a second.
No, I'm wrong. Sorry, Jerry.
I'm going to go here and I'll come back to you.
It turns out that President Trump chose to not reappoint Janet Yellen as being Fed chairman. And Jerome Powell, I believe, is coming
Yep.
in that position. It presents a unique opportunity in which there's a new Fed chairman, and I believe, are there 4 vacancies?
There will be, yes,
There'll
after,
be-
after current
Janet
chair
leaves,
steps down.
yeah,
Yep.
there'll be 4 vacancies on the Board of Governors. I'd appreciate your thoughts regarding the opportunities and risks associated with what may be either unprecedented or certainly not since the 1930s of a situation with so many vacancies on the Board of Governors and also a new Fed chairman.
Well, so first of all, I have great admiration for Janet Yellen. I think she's done a terrific job as chair. The good news is I also have great admiration for Jay Powell. He's been on the Board of Governors for 5 years, is a very thoughtful, intelligent, serious policymaker, and I think will do an excellent job as chair as well. And if you look at the president's first 2 appointments to the Board of Governors, you have Randy Quarles as the vice chair of supervision, who I worked with in the Treasury Department back in 06, 07. He was there, another very thoughtful policymaker, and now with Jay Powell, another very thoughtful policymaker. And so there are going to be some more openings, but so far President Trump has picked 2 people, his first 2 appointments, who are very serious, credible policymakers. And I think if he continues that record in filling out the rest of the Board of Governors, I think we're all going to be in really good shape. I would add to that, you're also seeing the strength of the system that Congress created 100 years ago, where you have 12 regional Federal Reserve Bank presidents that are independent. Right? I was not appointed by President Trump or by President Obama. I was appointed by a regional board of directors of leaders from around the 9th Federal Reserve District. And that was the system that Congress designed so that no one administration could control the entire Federal Reserve System. And so not only do you have, so far, President Trump making very thoughtful, reasonable appointments to the Board of Governors, you also have 12 regional Federal Reserve Bank presidents that are also bringing an independent perspective. So given all of that, I feel pretty good about where the Federal Reserve is, how we're staffed and where we're headed.
Thanks, Mark. Jerry, you had a question.
Sir, the biggest problem that the city of Winona and our area faces, and I believe all of Minnesota and the Midwest, is affordable housing. And I'm wondering, number one, does the Federal Reserve recognize this? And number two, is the Federal Reserve willing or able to do anything about affordable housing?
Well, I do recognize it. Everywhere I go around our district, not just Minnesota, I hear this question. Whether it's a town with a booming economy or a town with a slow economy, I hear this everywhere. Whether it's a Republican district or a Democratic district, I hear it everywhere. And so let me first say we acknowledge it. Second, let me say about what our tools are. So we can't directly control affordable housing. We control monetary policy. We have influence on bank regulation. We don't have influence on local ordinances. But we do a lot of economic research and try to arm other policymakers, local leaders, state legislators, the U.S. Congress with data so they can make informed policy choices. So my assessment of why aren't builders stepping in to build homes when there are people who can afford to buy them? That's the fundamental question that I think you're asking, because it's everywhere, right? If everybody needs affordable housing and people have jobs and they can afford a mortgage payment, why aren't builders stepping in? Well, the only explanation that I have is that there are local ordinances all around the region, layered on top of one another, that are driving up the minimum cost of housing. Whether it's a minimum lot size, minimum square footage, certain amenities, different regulations, layered on top of layer on top of layer, all of these things, each is good, it has a good intention behind it, but all of it is driving up the barrier for affordable housing. And so ultimately, this is not something that we at the Federal Reserve can directly control, but if we can educate local policymakers that each of these new regulations is actually hurting the working poor, then maybe we can layer on fewer of these regulations and we can lower the minimum cost of housing. That's the only explanation I have for why this is everywhere. Everywhere I go, I hear this exact same problem. And there's no explanation for it other than local regulations that are driving up those costs.
Thank you. I think we have a question over here.
Hey, yo. My buddy Bob the Builder, he got So,
It's not working.
By the way, you're on camera, live stream right behind you, just in case you were
Mr.
Kashkari. You can call me
Kashkari.
Neel.
So, if this guy I have a whole bunch of money that I need to invest. You know, I need to put it somewhere. And if this guy over here is selling piles of garbage, but this guy over here is taking a whole bunch of piles of garbage and putting them together into one big, one huge pile of garbage, why would putting my money in that be better than putting it over here? You mentioned that nobody ever saw it coming. I'm just curious about, if you could give a brief summary of the whole, mortgage-backed security issue and why they couldn't see that coming.
Well, I see. Well, first of all, I wouldn't recommend you putting your money in either pile of garbage. If you look back in world economic history, our species, humans, are prone to mass delusions. These happen every few decades, it seems like, or every 40 years or every 80 years. Whether it's the tulip bulb in Holland centuries ago, or the run-up to the Great Depression, the 1920s, or the tech bubble where people were just valuing eyeballs, or e-toys, things like that, or housing. In going into the financial crisis, we believed as Americans, it's going to sound silly now, but we believe that home prices never fall nationally. Because what happened in American history before that point, if one market was down, let's say Boston was down, New York and San Francisco were up. And you had the benefit of that diversification geographically. You never had a time when nationally home prices all around the country fell at the same time. And so that was the underlying belief that regulators had, that investors had, that banks had, that homeowners had, that we could be diversified around the country and that would protect us. So we all participated, myself included, in a nationwide delusion that home prices only go up. I bought a house in California in 2005. Right? In hindsight, that was a dumb thing to do. But a lot of us made these collective dumb decisions leading to this crisis. And that's the problem with these mass delusion events. They're obvious afterwards. They're not obvious on the way up. And so, I wish I could tell you this is not going to happen again. It is going to happen again. The question is whether or not we can have a financial system that is engineered to be strong enough so that when it does happen again, this financial system is strong enough to take it and we don't have to turn to taxpayers to bail it out.
Hi, I'm Janak, and I'm a student here at Winona State. I wanted to ask you a little bit about the interest rates and your inclination towards keeping it low. And since we can see that the consumer price index and all prices are going high this year, and I read an article where you were saying that the inflation should reach 2% before the Fed raises interest rates. So don't you think that with the prices rising and we're again entering into a phase of the delusion that you just spoke about, and will interest rates can solve that delusion or not? And I just wanted to hear your thoughts about it, and then probably an explanation as to why you want to keep the interest rates low, even when the prices are increasing and there's a probability of a bubble bursting or not.
So this is you asked an important question. It's a complex question, which I'm going to take a moment to answer. Congress has given us what we call a dual mandate. So the first part of that dual mandate is stable prices, which we've defined as 2% inflation year over year, collection of what we all spend on, whether it's housing and healthcare and food, et cetera, 2% inflation. The other one of our mandates is maximum employment, as many Americans working as possible. And typically these two things are related. So as the job market heats up and employers have to compete for workers, they tend to raise wages. That drives up inflation. So employment and inflation, you would think, are related to each other, kind of like a seesaw. Well, actually, to the gentleman's question, inflation has been coming in low, not high. So since the Fed has adopted this official target, which has been about 5 or 6 years, our average inflation rate's been around 1.3%, not 2%. So we've been coming in a little bit low. And the job market keeps getting stronger, and more Americans are going back to work. So because inflation is low, I'm seeing no reason to tap the brakes on the economy. My perspective is let's allow the job market to continue to strengthen, allow more Americans to go back to work, allow wages to strengthen, and then if we start to see inflation creep back up to our 2% target, we can tap the brakes then. I don't see any reason why we have to tap the brakes when inflation is continuing to run low. Now, other people say, well, look at the stock market. The stock market is high or other asset markets are high, but asset prices and the cost of doing business in the economy are two separate things. And inflation, as we define it, is focusing on the cost of goods for consumers, whether it's housing or healthcare or going to Target or Walmart and just buying the goods that you need every day. And so that's what we're focused on.
I got a phone call this morning from a community friend who asked, well, why not 0% inflation? Wouldn't 0% be better for workers, businesses, taxpayers than 2% or something else? And so what are your thoughts about the advantages or the risks of inflation being too low or I suppose even negative as we see in some economies?
Well, so that's the key. Negative inflation, which is deflation, it's a very tough thing for an economy because let's say you take out a loan. Let's say it's your student loan. We're talking to students here. So I heard that average student graduates with about $30,000 of debt. Is that right?
That was the figure that Brother William shared.
Okay, so let's just say $30,000 of student loan debt, maybe more. When I graduated with my MBA, I had $100,000 of student loan debt. So now imagine that prices are falling in the economy and the economy is shrinking because we're in deflation. Well, my debt is still $100,000. But if everything is shrinking and my debt is staying fixed at $100,000, in a sense, that debt is growing bigger and bigger and bigger every day relative to my earnings and relative to the size of the economy. So deflation is really bad for the economy because your debts are fixed and they just keep growing in relative size compared to the economy. So we all agree we want to avoid deflation. So what does 2% inflation do for us? It gives us a little bit of margin for error. We've been saying for the last 6 years, we want to hit 2% inflation. We've been hitting 1.3. Well, if we had said we want to hit 0 and we missed, we'd be in deflation right now. So we need a little bit of margin for error. And that's why most central banks around the world have agreed 2% is the right number. Consider it very low, but not quite 0 inflation.
Thank you.
Gentleman over here.
I think we got a microphone over here.
Oh, okay.
Yep.
Earlier you mentioned a little bit about the too big to fail banks and a little bit about maybe increasing bank reserves. I was hoping you could elaborate a little bit more on that.
Sure. My wife and I, when we moved to Minnesota 2 years ago, we got a mortgage to buy a house. And the bank made us put 20% down on our house. And we got a loan for the other 80%. Now, why does the bank make us put 20% down? That 20% down is designed to protect the bank in case we run into financial trouble, because that's a little bit of extra there. They can sell the house, pay off the loan, and there's that little extra cushion to protect the bank. That's what that down payment is for, it's to protect the bank. Well, you know what the funny thing is big banks in America basically put about 10% down on their investments. The analysis is very clear. If we make the big banks in America put 20% down on their own investments, that 20% will protect taxpayers just the way the 20% that we put down protects the bank. So that's what I'm talking about. It's the capital requirement for the bank, a down payment on their own portfolio of investments. If we increase that, we can make it so that the banks are safe and taxpayers are no longer on the hook. And that it's really as simple as that.
Thanks. Elijah?
Yeah. Well, as mentioned, my name's Elijah. I'm a student here, senior. First, I want to thank you, Mr. Kashkari, for taking the time to come to the bottom boot of our state to share your knowledge and expertise with us. Second, you recently had an op-ed published in the Star Tribune close to about 2 months ago. I think it was in October. And in the op-ed, you were critical of the Minnesota charter school program, even saying that we need to shut down Minnesota's failing charter schools in order to allow our good ones to thrive. You also stated that Minnesota has an exceptional education system, but only for certain racial groups in the state. So I want to thank you for acknowledging the educational disparities when so many have dismissed and even overlooked those statistics, at least in my opinion. And my question is, what is the Federal Reserve's plan to weed out the bad charter schools while promoting schools that have been successful? And will any recommendations be offered to address the cost of attending the higher quality schools for low-income communities?
So thanks for your question. You know, my biggest surprise moving to Minnesota 2 years ago was the extent of our disparities here. I didn't expect to see them because Minnesota has so much going for us, a very diverse economy, an educated workforce, on average, very good schools, on average, very high quality institutions of higher education. Yet those averages are masking these very big disparities around the state, racial disparities, geographic disparities, among others. And I started asking very basic questions about why these disparities exist and what can we do about them. And to be honest with you, I found very few good answers. And so we created a new institute this past year at the Minneapolis Fed that we call the Opportunity and Inclusive Growth Institute that is focused on doing research into unraveling the underlying factors driving these disparities. And I'm going to give you an example of a disparity that I mean. If you look at the U.S. as a whole, on average, African American unemployment is always twice white unemployment. So if it's a booming economy and white unemployment is 4, African American unemployment will be 8. If it's a recession and white unemployment is 8, African American unemployment will be 16. Even if you compare college graduate against college graduate or high school dropout against high school dropout, the ratio is basically the same. Now I started asking why. Again, very few good answers. So the Federal Reserve System has brilliant economic researchers all around the country, including the Minneapolis Fed, but all around the country. So I talked to our former chair, Janet Yellen, and Jay Powell, among others, and I said, let's create a research center focused on unraveling these economic disparities and trying to propose policy solutions to close these gaps. That the solutions are going to be partially education, segregation, housing. They're multifaceted, but we are committing to doing the research to make as much of a contribution as we possibly can to diagnosing the problems and coming up with recommended policy solutions. So that op-ed, I'll give you an example. The point of this op-ed was I visited a lot of schools when I was running for governor of California, but also in Minnesota. And I learned something remarkable. If you look at high-performing charter schools in New York City, they're oversubscribed, 4-to-1, 5-to-1, 6-to-1, with huge waiting lists because parents want to get their kids in these really good charter schools, and then they have to go to a lottery, and the kids are randomly selected, which is good for the kids who are selected, but the 60 or 80% of kids who don't get selected are really disadvantaged. Well, I visited a really good charter school in Minnesota that's doing really well, and I said, what's your waiting list? They said, we have no waiting list. I said, how can you have no waiting list when there are these huge education disparities? What I realized is that the average charter school in Minnesota is doing worse than the average traditional public school in Minnesota. The lousy charters in Minnesota are bringing down the averages and are confusing parents about which schools are doing well and where to send their kids. So the really good charter schools that are doing a great job are not oversubscribed today. So my conclusion from this is we need to stop being Minnesota nice, and we need to shut down the lousy charter schools so we can move resources and kids to the charter schools that are doing a really good job so that they can take advantage of those schools that are there. So that's just an example of some of the learning that we're doing. We have a long way to go, but I'm glad you asked the question, and we're going to focus on it for a long time.
So on this topic of disparities and inequities, do you worry about wealth concentration? Is that something you see as a problem for the U.S. economy?
Well, I mean, I think it's a symptom of long-time disparities that have been there. I think we're not going to be able to close all the gaps overnight, but if we can get to a place where everybody has truly an equal opportunity to get a good education, to get a good job, to build a better life for themselves, that's something that I think we should absolutely aim for, getting there as quickly as possible. I mean, to me, education has to be the great equalizer in our society. I think about my own life. So Devendra and I know each other for a long time. I was born and raised in Akron, Ohio. He was a professor at the University of Akron, where my dad was too. My parents came here from India about 50 years ago. We weren't rich, but I had a huge advantage because my parents were highly educated. I got a good education. That opened every door of this country to me because I got a good education. For me, education has been the great equalizer. Every door's been open to me because I got a good education. So if we can start by making sure that every young person in Minnesota gets a good education, I think that'll be a great start.
So are you a Zip?
My I'm a son of Zips.
You
I didn't
know,
go.
okay.
I didn't go to University of Akron, but my
Okay.
father
Just
was a professor.
Had to
there.
ask that for you, Chancellor. So, Ron, have you got somebody back there? Okay.
Going back to the point you made about missing the 2008, 2009 nosedive of our economy, and even going back to as far as before the Great Depression when our economy was booming. As it is now, our markets are doing great, housing's doing great, consumer spending's doing great, jobs are doing great, lending's doing great. Do you foresee another nosedive coming in our near future? Do you foresee something like that coming ahead that could be bigger than the Great Depression, bigger than 2008? And how can we combat that?
Sure. So we are actively on the lookout, but I'll tell you this: we never see it. And I'll give you some examples. So we had the tech bubble bursting in 2000, and when the tech bubble burst in 2000, it led to a minor recession. It was not a big deal, that correction. It was kind of a normal market correction. If that happens, that's fine. 2008, we had the housing downturn, which led to a devastating Great Recession and a long, hard recovery. What's the difference? We think the difference is because the housing market is so massively leveraged, right? People put 20% down. I put 20% down on my house. Some people put even less down, 10% down, 5% down, as opposed to the stock market where people take margin out in their stock account. Maybe your margin 1-to-1, so you put 50% down. We think, our belief is, it's the leverage that underlies the asset class that's a big determinant of how damaging it is when there's a correction. So we have a group at the Federal Reserve that's housed in Washington, our financial stability group, that's looking at all these different asset classes and looking for where they're priced relative to historical norms and looking for leverage underneath them, whether or not leverage is taking off underlying the asset class. So right now, we don't see signs of an impending correction that's going to lead to a terrible financial crisis. We do see high stock prices, we recognize that, but again, if there's just a stock market correction, I'm not that concerned about it. If there's a housing correction, that's much more concerning because of the leverage underlying it. So, look, I don't know how much comfort you should take from that, but our eyes are open, we're looking everywhere we can, but I don't think that raising interest rates to try to bring down the stock market is necessarily a good idea either, because that's going to directly affect wages, that's going to directly affect people's jobs, et cetera. There are costs to these tools. It's not free to just say we're going to do something in one part of the market.
So we're going crosstown to St. Mary's, I think.
Hi. I don't have a question, but I have 3 comments.
Okay.
Because I want you to know about Winona, so maybe I'm piggybacking a little bit on Jerry. I think we're really blessed in Winona because we have a very diverse economic base. But with that being said, entry-level jobs in Winona, when coupled with housing that's not affordable, and medical costs that in this region, medical insurance, are very high, it's tough for students coming out of college, for students coming out of high school, going into those entry-level jobs and making ends meet. So while the economy may be growing, I don't necessarily know that the entry-level jobs are providing people with the economic security that they need. So that would be point number 1. Point number 2, to piggyback again on what Jerry said, it's not only affordable housing in terms of affordable houses, it's affordable rent, which I think is a big issue for up-and-coming new professionals in Winona. And then my third comment on it's that whole too big to fail. I serve on the board of a local community bank, and the community banks weren't the problem when the economic collapse happened. So I would just say, as you think about policy for big banks or whatever, that don't make the policies so broad that you catch the good performers with the bad performers. So sometimes we regulate to address the big banks, and then you catch the community banks, which weren't the bad actors, and increase the costs to the community banks, which are the banks that ultimately, in places like Winona, are going to give mortgages to people so they can afford houses.
Yeah, so first of all, thank you for the 3 comments. On the third one, I agree 100%. So a year ago, the Minneapolis Fed put out a draft plan. We're going to put out the final version soon of what we call the Minneapolis plan to address too big to fail. There are a bunch of programs focus on the biggest banks, $250 billion and above, and we relax regulations on community banks because we agree they were not part of the problem. They were not systemically risky. If a community bank fails, we don't want that to happen, but it's not going to bring down the U.S. economy. And the perverse thing about the regulations that have come out since the crisis, the Dodd-Frank Act, is it made the advantage big banks have even bigger because they can afford with the regulatory compliance that the little banks cannot afford. And so I'm with you 100%, and that's why one of our planks is relaxing regulations on community banks so that they can grow and so that we don't have such a concentrated banking sector like we have today among the big banks. Thank you.
Ron? Oh, there you are.
Yes, I'm going to do a twofer here too, if I can.
Okay.
During the run-up to the election, President Trump commented, somebody asked about student loan debt, and he said, well, that's the most profitable thing the federal government has. Now, I'm someone who's old enough to remember when you could work a summertime job and have a part-time job during school and basically not incur any debt. You know, you didn't graduate $60,000, $80,000, $100,000 in debt. And since she mentioned community banks, I'd also like to do a twofer and ask about, you're in a region that has the only state that's in the black, and that's a public bank, the Bank of North Dakota. And now I see the new governor-elect of New Jersey is also a former Goldman Sachs person, but is also looking at that banking model. So would you like to talk about public banking and the role it plays in this area?
Well, there's a separation between, let me just start with some basics and I'll answer your question. I would start by saying there's a separation between fiscal policy and monetary policy. So the Fed's role is monetary policy, which is adjusting interest rates, the money supply, to try to meet our dual mandate goals of inflation and maximum employment. Then you have fiscal policy, which is either a state legislature or the federal government deciding how much they want to tax you and then what they want to spend that money on, and spending that money on education or infrastructure or defense or healthcare, as an example. So when I think about a public bank, to me that is a form of fiscal policy, which is using the balance sheet of the state to issue debt, to then use that money to go and spend on whether it's roads or education or something else. And so it seems like, to me, that's just a financing mechanism for the state to decide what they want to spend on. I mean, they could do it through a bank, or they could do it just by taxing their representative or their residents more. Those are just different decisions they can have on how they want to finance themselves. But at the end of the day, it's coming out of taxpayers' pockets, and they're choosing where they want to spend their money, be it higher education or whatnot. So I don't have a strong view on one financing mechanism for the state versus the other, but I do think, as you point out, it is important for states and the federal government to live within their means. You know, you can't run bigger and bigger deficits forever. So, you know, I think people need to be thoughtful about how much they're spending and ultimately where the revenue sources are coming from that.
Thank you.
This is actually a perfect segue.
Oh, I'm sorry. Second. Well, I mean,
Thoughts about student debt,
so, I mean,
the
it's
role of the Fed maybe in student
well, there's not much of a role directly for the Fed in it, but again, this is another fiscal policy question, enormously important. I agree with you. You know, back in the day, people didn't have to take on near the debt that they had. The Great Recession was hammered state budgets. A lot of states ended up cutting their funding for higher education, and then that turned to the students to go take on more and more debt. The student loans became the safety valve for the state budgets because the view was students can just take on more and more debt. And so a lot of students are facing bigger and bigger debts. And I think it's forcing students to become much smarter consumers in terms of the education that they're buying and making sure that they're focusing on majors where there's a decent chance of getting a good job when they come out of it. But we were talking right before we came down here about innovative education models to try to reach more students, more access without running up increasing costs. So I agree, it's an enormously important issue, not something we directly control, but it is something that I think as a country we have to focus on because returns to education are just becoming more and more important. And as technology becomes more important in our economy, education is just becoming more important. So more and more students are going to need higher education.
Thanks.
So I guess what views do you see with the monetary policy with the new GOP tax bill that's being revised as we speak? Where do you see where that's going to go with? You brought up how it's different than monetary policy due to legislation, but what are you foreseeing that could happen?
Well, we pay very close attention to what Congress is doing. And if Congress passes something, then what we end up doing is updating our economic models based on either their new tax programs or their new spending programs to see what do we think it's going to mean for the overall economy. And then we adjust our path of interest rates to try to fit whatever that economic reality is. You know, the markets had a lot of optimism after the election. The stock market boomed. Part of it was an assumption that Congress would be passing all sorts of new legislation. Now, I didn't believe it. I didn't believe the markets knew anything about what legislation was actually going to come. I think the stock market is a lousy predictor of political outcomes. So I did not adjust my forecast. I'll give you an example. The stock market did not predict Brexit. The stock market did not predict accurately the results of the November presidential election. So I don't have any confidence that the stock market can predict what fiscal policy Congress will end up enacting. So if Congress passes a bill that the president signs, I and others around the Federal Reserve will update our economic models based on what we think the likely outcome is going to be. And then that may change our path for interest rates, but we need to see what they end up actually passing, whether it's permanent, whether it's temporary, whether it's really going to lead to a change in the trajectory of the economy or not.
Well, while we're talking about Washington policy, do you have any thoughts about, rolling back the NAFTA or the Trans-Pacific Partnership or other kind of free trade agreements? There seems to be some tension in Washington about, are we for more free trade or less free trade? Do you have any thoughts about free trade and how that affects the U.S. economy?
I mean, there's no question. I mean, we're learning, we're reminding ourselves, we already knew this, but we were reminded over and over again that there are winners and losers. There are losers, right? If your industry gets dislocated by competition from abroad, you end up suffering. There's no question about that. There's also no question that as a country as a whole, we have benefited tremendously from free trade, and we will continue to benefit tremendously from free trade. And so trying to just pull up the drawbridges and become isolationists where we're just going to trade within our own borders is a loser strategy for the country. And I don't think that people of either party want to have that happen. And so I think we need to come up with trade agreements that work, that are fair, and I hope that we end up with that, fair free trade agreements.
Thank you. Yeah, Ron.
Hi, I'm a student here too. I'm in the CME department. And to go back to your earlier question about, or your earlier response to education, that is a very important step for people to become successful. Oh, do you think that there is should be more pressure on the school to, or the teachers specifically, because there's a very large generational gap, and we are learning the same way that the teachers were taught, and then what they applied from there. But there's a lot of technology changes that when we graduate, we will be using that we should be learning now. So when we do graduate, we're already ready for that and then can build further so students can more spread their wings, not so much fall in line.
Well, I think all universities need to adapt, and their curriculums hopefully are adapting with the changing workplace and with the demands of employers. I don't know who I was discussing with some folks earlier, some things haven't changed. Calculus is the same calculus as it was 100 years ago or 200 years ago. So I'm not sure the calculus needs to change tremendously, but the computer programs, when I was first in engineering school, the first programming language I learned, first of all, I learned BASIC in elementary school, and I learned Fortran, I think my freshman year of engineering school, and then C later, and then C++. So I know the programming languages have changed, so I'm not encouraging you to go study Fortran. I'm expecting that all of your curriculums are being updated, but I don't think you have to update everything at the same time. I think certain classes and certain technologies do need to keep up, and hopefully your schools are doing that. And you're giving feedback to your teachers and to your advisors about the types of things that you want to be learning so that you are as skilled and as relevant when you graduate as possible. So I do agree with the spirit of your question.
Thank you.
Hi, I have a question. I want you to tie in the student loan question with something you said earlier about the highly leveraged asset pools are the ones that are dangerous, riskiest in terms of future failure. And the question is, to what extent does this generation of highly leveraged individuals, what kind of impact will that have on the economy, sort of near to long term? And secondly, but relatedly, does that, in terms of looking about what could possibly go wrong, is that something that's on your watch list, or maybe that asset pool isn't large enough to?
Well, I think the asset pool is large enough, but it's still very clear. We were talking about this earlier. The returns to higher education, even with the debt, I mean, it's still resoundingly positive. So if you compare a group of folks who go to college and graduate against those who don't go to college, those who go to college and graduate are far better off over their lifetime earnings than those who don't go to college. So the returns to college are still resoundingly positive. And so, but I mean, admittedly, we want to keep student loan debt in check. It is a heavy weight that is a barrier to people buying homes, to all these other economic transactions that they want to get involved with. So we want to manage it and not let it grow out of control. But I don't think anybody is suggesting that the returns to college are now negative. I don't think there's any data that supports that. It's still resoundingly positive. So I'm not sure if I'm answering your question. It is something we pay attention to. If it were to grow out of control, then I do think it'd be something to concern. I don't see it as something that's going to crater the economy in the near term because the returns to college are still resoundingly positive, whether they're financing it through working while they're going to school or taking out loans and paying it back later.
My question is more towards their ability to participate in the economy given their debt.
Yeah, no.
So the question is, can students who have a lot of debt participate fully in the economy?
Yeah. And again, I guess I'm trying to answer the question. The fact that it's still resoundingly positive investment for the student to take on the debt to go to college if they graduate. Now, granted, if they don't graduate and they have a bunch of debt, then that's clearly worse. But assuming that they graduate and we have a strong economy and they're able to get a job, then I still think society is better off down that path versus not having them get that education. Now, I agree, in an ideal world, they would get the benefit of the education without the cost, without being saddled with that debt. But that doesn't appear to be on the table right now. So if the choice is education with debt or no education, I would still say society and that individual are better off with education with debt than no education.
Ron?
Thank you for taking my question. Quick comment, I am employed in the building trades, and while regulation does play a factor in cost, it doesn't simply boil down to that as a sole factor for high housing costs. I do have a question about your philosophy of the house on fire and the Fed's role of taking care of financial crisis and where that ends. Does that end in the borders of the United States and financial crisis there? If Canada's on fire, do we put that fire out? London, surely not Russia. Where does that responsibility end?
It's a good question. I don't think there's a clear answer. I mean, I think the question is how much damage do we think that crisis will end up doing to the U.S. economy? So one of the concerns, so our plan to address the too big to fail issue, we can only apply it to U.S. banks. If Congress were to adopt our plan, it would apply to U.S. banks and to foreign banks that are doing business in America. But to your point, Europe likes to take big risks with their banks. Their banks are less capitalized than our banks. So even if we made our banks safe and Europe took huge risks with their banks, that doesn't mean that we're completely protected. Because the fact is we do live in a global economy. And so, in the 1990s, the U.S. government bailed out Mexico. Now, why did we do that? Did we do it to be neighborly? Did we do it because they're our ally? Did we do it because Mexico is an important trading partner with the U.S.? Probably all of the above. And so I think it would depend on the unique situation of that crisis to figure out, would it be in U.S. taxpayers' interest to use their own money to go step in and stabilize a crisis somewhere else? I don't have a clear-cut answer for you. I think it's going to be situation-specific. But I think you're right. There probably are cases where a crisis abroad would be so intense that it would affect America, but it would make sense for us to do something. Not all the time. Here's a follow-up question.
With increased connectivity in the,
With increased connectivity in the global markets, will that not always be the case, though? That would negatively affect
Well, I
the
think it
United
depends
States
on the
taxpayer.
size. You could imagine, say, for example, take Greece. So the Greek debt situation, you know, the U.S. government, U.S. Congress didn't step in and say, we're going to do something for Greece, because the Greek economy is pretty small and it's pretty removed from the U.S. economy. But Greece, even though it's pretty small, is an integral part of the EU, so you saw the rest of the EU stepping in to stabilize Greece. So I think that's an example where it probably wouldn't make sense for America to do it, but it did make sense for countries that were more closely connected to Greece to step in and do it.
But then might have Greece led to Brexit. Well, anyway, yeah, I think we have another question over here.
Good evening.
Oh, hi, Ken.
Wages have been mentioned in several comments and questions, and there are an awful lot of workers in this country whose wages have remained extremely flat over a really long period of time, and it kind of runs the gamut across many different sectors in the economy. So from a policy standpoint, is trying to encourage wage increases through, you know, is that something that the Fed would do, would have an interest in doing?
Yeah, absolutely. I mean, so this is something we're very focused on because of this relationship between the job market and inflation. We think the mechanism that these two things are connected is through wages. And so, you know, I travel all around the district asking employers, you know, what are you seeing? And employers in many parts of the district say to me, our biggest problem is we can't find workers. We cannot find skilled workers to take our jobs. We could expand if we could find those skilled workers. So I always ask them, I say, okay, you can't find workers. Are you raising wages? And usually the answer is no. And then what I say is, well, then you're just whining, right? Because supply and demand means if you want more supply of something, you're going to have to pay more for it. And then people will respond. Well, they want more of something, more labor, but they don't want to pay more for it. That's just whining. So yes, we're looking for every sign we can see of, are wages going to go up? Is there really competition for labor? Is the job market really tight or not? This is something we care a lot about because this is the connection between our maximum employment mandate and our inflation mandate. Now, we can't legislate it. I mean, that's not for us to control it, but we can try to see what employers are doing for signs of whether or not wages are growing. And that, to me, the fact that wages have been growing very slowly is the biggest sign that I have that there probably is still some slack in the labor market. If the labor market were truly tight, businesses would be forced to compete with each other for workers and wages would be going up. And we're not seeing that. That tells me there's still some slack in the job market. Thanks.
Thank you for being here. I'd like you to speak to for a moment to open market operations, if you would, and just where historically speaking, where we are as far as how much debt the Fed holds, and if that's a concern to you, and where that lines up historically. And then with interest rates being as low as they are, if we do hit that crisis, what tools do you see as having available when we already have so much of our own debt in the Fed and having interest rates at historically low levels?
Sure. So let me start by explaining how we adjust interest rates. Typically, the way we adjust interest rates is we adjust an overnight rate, which is a rate that the banks basically lend to each other or borrow from the Fed, called the federal funds rate. It literally is an overnight rate. It's 24 hours. And you think about it this way. If you own a business, you don't really care about overnight interest rates. If you're going to borrow money to build a factory, you care about what interest rates are going to be over the next 5 to 10 years. So we adjust short-term interest rates to try to adjust the path for interest rates over the next 5 or 10 years. Now, once the crisis hit and the Fed brought short-term interest rates to zero, the question was, are we out of ammunition? And the answer was no, because then the Fed started buying up long-term bonds to drive down those long-term interest rates directly. Again, by lowering long-term interest rates, it makes it cheaper for you to get a house, to buy a house, or for a business to get a loan to go build a factory. So now we have about $4.5 trillion of long-term U.S., not just long-term, but U.S. Treasury bonds. Well, over the summer, we announced a plan to start shrinking that balance sheet gradually over time. And that plan is now underway, and it's happening in the background. And our plan to shrink that balance sheet back down to over time is to basically allow those bonds to mature. So if we own a 10-year Treasury bond, after 10 years, that bond matures, and the U.S. Treasury Department writes a check to the holder of that bond and pays it off. And that's what we're doing. That balance sheet is slowly going to converge back down to a more normal size over the next several years. That process is ongoing. It's being conducted through open market operations at the New York Fed. It all seems to be working fine so far.
Please.
Hi.
There seems to be a persistent effort to dismantle the Consumer Financial Protection Bureau. And I just was wondering, what are your thoughts on that? Do you think it should be, the Bureau should be strengthened, or it's okay to weaken it, or?
Well, this is, this is really a call for Congress to make on regulation. And it is an institution whose design is to protect consumers, right? Who could be against that? And I'm certainly not against protecting consumers. I'm in favor of protecting consumers. From my perspective, in terms of the risk of a financial crisis and a financial collapse, I think that those policies are best designed through things like the Federal Reserve and bank regulation and capital requirements for the biggest banks. But at the same time, the lady to your right talked about a lot of the regulations that are swamping community banks. A lot of the regulations that I hear from community banks that they're frustrated with are regulations around consumer protection. And so this is a question of Congress finding the right balancing act of, are we doing enough to protect consumers? Are community banks being smothered at the same time? Do we have that right balance? I don't know if we have the right balance. I do think it's appropriate for Congress to weigh in, and then they may decide, hey, Consumer Protection Bureau, you need more tools, you need fewer tools. I ultimately think Congress needs to make that call.
So you heard some great questions today from some of our students. We're running out of time, so I guess I'd like to ask one last question of you about them. What advice would you have for these young people, for these students, about preparing for the economy of the future, especially those who might want to go into economics or go into government service, but just in general, how should they best prepare for the economy that they will find themselves in when they graduate?
Well, I think number one, you need to be smart consumers. You are a consumer of education, and it's on you. You know, I used an analogy, I think it was earlier, about the Food Network. Did I talk about it here? No, it was my earlier meeting. So, you know, when the Food Network took off, and there are all these shows like Top Chef, all these young people got inspired and said, I'm going to culinary school. And then they graduated with all this debt, and there were no jobs as chefs. And they said, wait a second, what happened? I was so inspired by Top Chef. Well, that's on them. And so at the end of the day, you need to be a smart consumer about your education resources. I mean, you're spending your money, you're taking out loans, and you need to look, are there good job prospects for what you are majoring in? So my first advice to you is be a smart consumer about the education investment that you're making right now. Second of all, I would say that life is long, right? I started out as an aerospace engineer, then I went and I got my MBA, I went into banking, then I went into US government. You can do lots of different things. Your first job does not have to be your last job. You can change careers. There's been no plan to my career. What has governed my choices has been I've pursued things that I find very interesting and very challenging. And if I'm genuinely interested in it and I'm genuinely challenged by it, there's a good chance I'll end up doing my very best. And if I do my very best, I'm more likely to be successful at it. And so I would just say find something you're genuinely interested in, and hopefully it's something where there's some demand for that in the marketplace. And if you can find those two things aligned, I think you'll be in really good shape.
Well, thank you for your wisdom, and thank you for your transparency.
Thank you.
Thank you especially for coming here to Winona to have this conversation with us. We're honored to have you. Would you please join me in thanking Federal Reserve President of Minneapolis, Neel Kashkari. Thank you so much.
Thank you very much. I really appreciate it. Thank you.